You're watching a Carolina Business Review special presentation in partnership with the Charlotte Chamber of Commerce. Major support for this program provided by Babson Capital Management, a leading global asset manager with over $200 billion in assets under management. Learn more at babsoncapital.com.
Last week on part one of the Carolina Business Review Charlotte Chamber Economic Forecast, we started with the broad economy. This week we get into more of the details on part two. Please stay with us.
This is the 2015 Economic Outlook Conference, featuring David Carroll, Senior Executive Vice President, Wells Fargo, Susan DeVore, President and CEO, Premier, Lynn Good, President and CEO, Duke Energy, Jeffrey Lacker, President, Federal Reserve Bank of Richmond, and Brian Moynihan, Chairman and CEO, Bank of America. And now, from the NASCAR Hall of Fame in Charlotte, your moderator, Chris William.
Welcome. Welcome. Happy New Year, happy holidays, and welcome to our broadcast, and welcome to our guests and panelists. And I might say esteemed. Thank you for your time, and thanks for taking time to do this. Some friends of mine in the business said that they are a little perplexed because they haven't seen business allocating capital like they have pre-2008 levels. How does Duke do that? How do you feel about that? And what do you hear from some of your colleagues and maybe some of your customers about CapEx, if you will?
You know, I think capital for our industry, we're one of the most capital-intensive industries in the U.S.
Yeah.
So day in, day out at Duke Energy, when we open the cash register, we are cash flow negative, relying on the capital markets to keep things going. I mean, that is what the industry is. Just maintaining the system we operate requires capital. And you think about, even during the midst of the economic downturn, we were still wrestling with regulations that continued to drive mandated capital expenditures for us, whether it was in the environmental space or whether it was cybersecurity or other things that required capital outlays. So throughout the cycle, we have been heavy capital spenders. I would say if I look, 13, 14, it will be trending up in 15 as we have some more optimism and some more need to deploy more growth capital. And those are decisions that are tough to make in my industry for some of the reasons that we've talked about here: uncertain economic conditions, volatile energy markets, rapid change in technology. I'm trying to put capital to work for 20, 30 years. It's hard to make those decisions, so we wrestle with it. And we have found the capital markets to be very available to us, and we're able to finance what we need. The tougher decisions are where to put the capital to work because of the changing and difficult business environment.
Is it different now than it was?
I think the pace of change has been extraordinary for our industry, and I suspect for others. You look at the transformation that's going on with smarter and cleaner and more efficient energy. We're trying to put all of that capital to work in a way that transforms the system, but does so in a way that still provides reliable service and is still cost effective, because we're part of the economic landscape on how well the economy in the U.S. is going to do. And if I'm expensive, I can impact other businesses. So that's the constant strategic challenge that we have on capital.
Yeah, Brian, since you had brought that up earlier, expand on that a little bit. You think folks are being reticent to allocate capital as they maybe normally would pre-2008?
I think that they're improving this year over last year, because we were sitting in last year, we just had the government shut down and the financing, whether the government was going to work and whether they're going to get funded. This year, since that got taken off the table, you are now seeing businesses sort of with the economic growth projections moving across 3% generally among everybody, with a view of the United States having a long-term supply of energy. They're saying, okay, now we can deploy capital. So they're more frisky this year than they were last year, honestly. But it's still slowed down by, if we were here 2 months ago, we wouldn't have been talking about the oil situation that much. It would have been kind of out there. 2 months later, it dominates 24/7. So that kind of volatility in their outlook it freezes them. And because we all invest across decades in the question happens. So I think they are more constructed. That's why the M&A activity is up. You're seeing a little more drawing on the lines of credit by commercial customers that have the availability in the lines, which means they're investing in something because they could, to either employees or capital. So I think it's better now. But I think it really will take a few more quarters to sustain non-interruption of the imponderables and a good growth for them to get even heavier invested.
And what's the official word from the central bank, Jeffrey? How much cash are companies sitting on as compared to maybe last cycle?
It's in the data. I haven't looked in a couple of weeks. It's a lot.
A lot more than you'd expect.
It's a lot more than was typical for this part of the business cycle. But there's been a secular uptrend in holdings of cash. But it's what you'd expect in a low interest rate environment, I think. I don't think interest rates are constraining investment demand. It's how much capital is needed for the demand flow, the orders, the business they have to satisfy. My sense is that that's what's been constraining demand, less than an internal rate of return hurdle that's driven by our interest rates.
David, what do you think?
Yeah, actually, in the most recent quarter, fixed business investment was actually up over 7%. And for the year, I think our economists tell us it'll be about 5%. And that in the short run, the drop in energy prices will, on the margin, suppress investment just because mining and commodities represent such a big cohort in total investment spend. But I'm optimistic that it is firming up. And our largest trading partners are sick. Europe is teetering on recession. Canada slowed down enormously, so that'll weigh on us. But I think the trend, when I talk to our clients and business owners and people that run the large companies that we do business with, it's a different tone in their voice than it was a year ago, 2 years ago, 3 years ago. There's still a lot of uncertainty out there, and the drop in oil is one. But anyone that's dealt with the EPA lately would tell you that it's not getting any easier to do business in many places in this country. So all that combined, I'm net positive on a year from now, 18 months from now, seeing better fixed investment.
So, Susan, how do you, given what we've just been talking about, and especially given, again, the ACA deployment and some of the big changes that are coming next year and beyond, how do you allocate capital? And here's another easy one for you. How do you figure out where the ball's going to be? And will there be more consolidation in healthcare? Is this uncertainty going to force consolidation?
Definitely more consolidation. They need the scale. The challenge health provider systems have is with all the demand that's coming through the additional coverage and the aging population and the health of the population, do they build more facilities because they're busting at the seams with the facilities they have when they know that what's coming down the pike is a movement of those patients to other settings and a pressure on the cost? So they have a challenge in deciding whether to build that today given the uncertainty of the future. In addition to that, healthcare is probably the least interoperable industry from a technology perspective. So they're making huge technology investments so that you can actually connect the data from a patient to a doctor, to a hospital, to a nursing home. And those investments are really significant.
We're going to run out of time pretty quickly, and I want to talk about a couple of current events. Recently, Sony, in a very high-profile news story, if you will, suffered what many are calling the Sony hack attack. I don't think there's anyone on this dais that does not worry about cybersecurity. Lynn, we'll start with you. I mean, especially with the assets that Duke Energy has. How much does this change and I'm talking about the Sony attack, how much does this change the urgency that you have around aggressive cyber attacks?
Chris, I'm not sure it changes the urgency, but it just reminds us of the extraordinary risk that we have in nation states and others. It's not just a hobby to hack, it's a business that has political ramifications. And you often hear that the electric grid is something that is a part of the infrastructure of the U.S. that would be enviable to hack into. So we have had heightened cybersecurity attention in our industry for some time, working closely with the Department of Homeland Security and working closely with other governmental agencies. And the Sony event just reminds us that it's not only the infrastructure, it's also the email system, it's the customer accounts, Target, others. I mean, it is just an ongoing issue. And so we run cyber almost like we run, daily security checks of other sorts around our system, physical security, because I think that heightened sense of awareness is just something that is so critical. It takes a lot of attention, a lot of money, and a lot of resources, and I don't see that changing.
Brian and David, I have to ask you this. I know a little something about banking, just enough to ask some questions. Give us a sense of the cost it is for a bank the size of both of your banks to defend against these kind of attacks. Has this Sony event changed the way you look at it? And does the federal government need a better reporting and mitigation for cyber threats, besides just you standing on your own figuring out how you're going to defend yourselves?
It's hundreds of millions of dollars. It's thousands of people. It is everything from how an employee, a teammate behaves with their personal things, hygiene, in terms of email content, downloads, all that stuff, all the way through to the most sophisticated attacks in the world coming at you and how you handle all those dimensions, insider threats, external threats. And so it's just something that we work on every day. And we have, knock on wood, we've had very talented teammates that have been able to do a good job. And so what you're seeing now in the aftermath of this is actually, along with other similar situations, is the public policy debate is really starting to form, which is, okay, how do you handle this? In the world of running physical facilities, a lot of us do, if somebody comes in and tries to rob a bank branch or something like that, it's very clear what the rules are. In this world, it's very unclear. And so this policy debate is going to dominate a lot of discussion over the next several years. And it's hard to get something done in it because it runs in a lot of different directions where people have points of view. Meanwhile, the federal government is convening teams, financial services industry, energy industry, power industry, energy industry, critical infrastructure, and is allowing us to exchange more information. They continue to push it. Would we want more? Sure. But then there's matters of national security, so you have to be careful. But on the other hand, it's incumbent upon us as industries and incumbent with the government to share the information to try to make sure nobody has this. This is not good for anybody if this happens. It's not good for anybody.
Does this refocus the policy and the practice?
It doesn't really change anything for us. I would suggest that beyond regulatory risk and reputation risk, cyber is the biggest risk that we face.
What does it cost the bank?
It's, as Brian said, for us, it's hundreds of millions of dollars, depending on how you want to cut it, and has been for a number of years and is growing certainly double digit every year. So it is clearly seen as one of the top three primary risks we have. I do think as a nation, we can and should be more coordinated at the federal level, not just within several critical industries, but to create a framework where it's easier to share information than we have today.
Yeah, Dr. Lacker, is there some initiative, is there some talk around the member banks of the Federal Reserve or the central bank that can help maybe congeal this more?
So we're as active in this space and feel the same sense of urgency that all my colleagues on stage here do, particularly the banks, because we are like an infrastructure for the financial and banking system. Payments that flow through our computers are highly critical for the economy. So this has been a focus for a long time. We've been aware since 9/11 that there was a terrorist attack focused on trying to bring down the financial system. And the banking sector certainly aware of targeted attacks at them. And so now with Sony, we see it targeted at the entertainment industry. But I think that vigilance has been growing, and the investments are growing commensurately. And I think the coordination and the structures are there through the Financial Services Roundtable and Kelly King's good work and others. I think we're doing a lot to try and coordinate responses.
Dr. Lacker, let's stay with you. Let's talk about interest rates. It's your favorite topic, I'm sure, right?
You've been talking about that this week.
It's funny thing about that, right? You've got a new chairman, Janet Yellen. You have been on the Federal Open Market Committee now for 10 years?
It's my 11th year.
Yeah, it's
as a participant.
Pretty amazing. And tend to be a dissenter, which is not a bad thing. You tend to bring some reasonable debate to the dialogue. I won't ask you to comment on that. I know you can't. And here's something. Where are rates going to be next year, and are they going up, and when are they going up?
I think it's highly likely rates will go up next year. It's not a certainty, but I think it's quite likely. An economy with a growth rate where it is now or slightly higher, picking up, an economy with resource utilization at the levels we're seeing now after the long expansion out of the deep recession. Economy like that is going to need higher real interest rates, meaning inflation-adjusted interest rates. And it's important for the central bank not to impede that adjustment process. And that's why I think my belief is that it's quite likely the time will come this year when we'll need to raise rates, the short-term interest rates that we control in money markets. People talk about inflation. and inflation's been running below our target, not by much, but about a half a percentage point below our target. It could be a couple of months before we know whether the inflation rates are going to come out of this dip at around 1.5 to 1 3/4 where they are now. I think they will. I'm pretty confident that inflation is headed back towards our 2% target over time, and as long as we're confident of that, I think we can set aside a minor deviation of inflation from our 2% target and set interest rates in a way that matches up with what real economic conditions warrant.
You know, Lynn, your own words were that your company relies heavily on the capital markets, and two risks, and I know you know this well, two risks are the capital markets themselves, but also the cost of funds.
Yes.
So when you hear Dr. Lacker speaking, how do you plan with your group, and how do you, again, look around a corner? Would you expect it in your business to be harder to be profitable in the next year or two based on that?
You know, we do plan for rising interest rates. We don't always get it right, but I think business in general has been expecting over time that interest rates would rise. And of the two things you mentioned, Chris, access for us is the big thing. Price is important, but access is extraordinarily important. So lines of credit that provide some underpinning for us if the capital markets start to go crazy. We look very much at access and liquidity as a key part of our underpinning, and then we plan over time that interest rates will rise. So in 2015, we will finance something over $3 billion, and we expect it's going to be more costly for us to do that in 2015 than it was in 2012.
So if it's more costly for you, then it's more costly for ratepayers?
You know, we don't pass through directly. So, our rates are set periodically. Interest rate rise in general is something just becomes a cost of our business. We'll reset those prices sometime in the future. And presently here in the Carolinas, we don't have a rate case planned until 2018 or so. So that price becomes a cost of us doing business in the interim.
David, Brian, the heart and soul of a business is the interest margin, and you've been under a lot of pressure with rates as low as they are to make money on lending money. But you've had capital markets that have been pretty incredible. So how do you manage that transition to hopefully rising rates as a banker from capital markets that have been pretty exceptional the last couple of years? David, I'll start with you.
Yeah, as we always hasten to add when we're meeting with investors, we don't manage to a certain net interest margin. We manage customer relationships and pay market rates on deposits and charge market rates on loans, and the margin falls out. Having said that, in the rate environment we've been in, our net interest margin has contracted for over 5 years in a row. We've been fortunate that we've been able to deal with that through other sources of revenue on the capital market side. And typically in a rising rate environment for a company that's asset sensitive as we are, liability pricing lags. So we actually would like to see higher interest rates for lots of reasons. It would suggest a stronger business environment and a more normal inflation. But one thing that gets a little esoteric, but it impacts our businesses, is a function of what happened with Dodd-Frank and some of the changes that have been made in our industry. I was looking the other day at the 50 largest investment grade issuers of debt in the U.S., and Wall Street inventories of their bonds are down 85% since the passage of Dodd-Frank. So that's fine right now when we've had muted and next to no volatility. But it is, as we're going through our stress test right now, Brian and all the banks are this time of year with the Fed, and you look at various stress scenarios, it's a question mark as to what happens in highly volatile market conditions for the big debt issuers. And is there going to be the kind of liquidity there? And what will that mean for pricing? And typically, if we're liquidity constrained, price is going to go up. So,
right. Brian, what do you think?
In terms of, David described the business model, which is you lend money out at a rate and you pay people for their deposit balances, and when that crunches, it hurts. So you adjust your cost base. But I think you've got to be more philosophical about this, which is if the economy is growing 3% plus next year, Dr. Lacker and his colleagues view that as sustainable. They're going to move rates up. But the best news in all that is the economy is going to be growing. If the economy is picking up, that's a good thing. It'll be better for everybody out there in terms of making money, employment, wage growth, et cetera, and rates will reflect that. Meanwhile, this thing that you're asking about long-term capital costs, the rate structure in anybody's view, from the Fed to the markets, is so much lower than we've experienced in our business career, other than the last 4 or 5 years now. These are meaningless differences. 3% or 4% on a 10-year. It's 100 basis points, so it's 30%. Yeah, but it's still 4%. Or 2 to 4%. And the issue is, it traditionally has run 200-300 basis points higher than that, the Fed funds rate, 3%. This rate structure is so low and so accommodative to people who are going to invest and borrow long term. That I don't think changes for a good while because the growth isn't strong enough here or around the world. Dr. Lacker, we don't see that. So all the rate predictions are fairly flattish curve with a low long-term bond rate attached unless there's a mistake made.
Not to get too detailed here, Jeffrey, but to take that a little bit further.
So I think there's a lot of uncertainty about where we're headed, where both short rates are going to be, say, 3-4 years from now. I think maybe more than in the typical cycle. We've had sort of this pattern, rates go down in recessions and come back up. Across the last few expansions, they've gone up less, where they've topped out less. You might look at that and say, all right, there's some secular trends that are driving real interest rates down. And there's certainly a good case to be made for that, but I think it's fairly speculative and it's hard to know for sure. And we're going to have to pilot policy in a way that avoids the risks of moving up too slowly and getting behind the curve, and then having to really stomp on the brakes in a way that causes a recession.
We have less than 10 minutes, and I want to come back to something with Dodd-Frank, but Susan, I haven't forgotten about you. I want to ask you, the cost of capital, when we use that term in groups like this, sometimes it can get lost on folks, but the cost of capital is what you pay when you borrow. So how does that make your job harder? Does it make it harder in the uncertainty of whatever is going to happen with ACA and healthcare, or is it really on the margins, not so much?
Cost of capital for our 3,400 hospitals and health systems around the country allows them to make the capital investments they need to make. And a lot of them live on very lean operating margins, and they don't have a lot of excess cash flow. So low interest rates allow them to make the investments they need to make.
Yeah, okay. Actually, we have 5 minutes. Brian, David, Dodd-Frank. How punitive is Dodd-Frank going to be in the next 2 or 3 years? And I don't mean just as an operator of a bank, but as a depositor in a bank. How will it show up to depositors, to shareholders? What's your best guess? Brian, start with you.
Let's start. I thought this was going to be a holiday gathering, so we do. To get David and I up here to talk about bank regulation is not exactly a holiday gathering. Look, there's a lot of debate that's gone on with some of the recent changes, a couple things, but you have to step back and say what was trying to be done, and how much have we done, and what the industry, the regulatory fraternity, the policymakers basically said the industry didn't have enough capital, didn't have enough liquidity, engaged in a scope of activities which we didn't think was what they should have been engaged in, and basically what Dodd-Frank does is effective. Dodd-Frank and the rules all around Dodd-Frank increase the capital, increase liquidity, and pared back the scope of activities to what people would think is more real economy supporting activities, whether it's in capital markets or whether it's in real banking, so to speak. All that's been accomplished. And so the question now is going to be, like with any regulation that had so many things that went through and so much it touched, is constantly making sure it has a balance for real customers who need to borrow and have access to capital markets. And our role as an intermediary between our customers like Lynn and Susan, people who borrow and access capital markets, our investors who invest in those markets, individuals and things, and how we intermediate. And we have to play that role because no one else plays it. And so as we get through it, I think there will always be a little ebb and flow in that to bring that back to normal. So I think largely the regulatory configuration addressed the major issues, and there's resolution planning and other things that get more and more technical. But the reality is it largely addressed the things. And to simply put, you think about Bank of America, twice as much capital, 3 times as much liquidity, and 1/3 smaller than we were at the beginning of 2009. And so no matter how you cut it, it's had an impact. In our scope of activities, we got out 60 different operating divisions and pared back a lot of different things. So it's had that impact on us. It's had that impact on all the companies in the world that do this. And so that's not inherently a bad thing. It was a good thing because those are the things that were behind the excesses that caused the situation. The correction now is to make sure it doesn't affect the real economy going forward. And that is a ticklish balancing of what you want to have. And so David mentioned liquidity and bond trading. That is impact. There's not a question. It's mathematically provable right now. The question is, will it stay that way over time? I think will play out. But right now, you can see that there's been vagaries around the market in times of stress in terms of ability to hold inventories and things that will play out. And then there'll have to be an honest dialogue about what is the right role for people intermediate in capital markets and how they hold those assets and how they value those assets. And that's going to be the debate, and how they're priced to hold them.
Yeah, well said. David, you have about 30 seconds.
Yeah,
Can you wrap that up?
A lot of good things came out of Dodd-Frank. Truly, the industry is more resilient, it's better capitalized, less risky, and we should all not lose sight of that. The bill was signed into law 4.5 years ago, and less than half of the rules and law regs have been promulgated. So to say what's the impact going to be out in the future, it's hard to say. It's been painfully slow. But I would agree with everything Brian said. There were good things in there, but I've often analogized it to going to my grandmother's bathroom and opening the medicine cabinet and taking one of everything in there. The bill was 2,300 pages long, and we don't know the unintended consequences, like the scarcity of liquidity and investment-grade fixed income.
I'm sorry, David. I know I hate to do that, but next year we'll come back and pick right up there. David Carroll, Susan DeVore, Lynn Good, Jeffrey Lacker, always nice to see you in Charlotte. Brian Moynihan, thank you for being here. Ladies and gentlemen, thank you for joining us. Our thanks to our partner at the Charlotte Chamber. Happy holidays. I'm Chris William. See you.
You've been watching the 2015 Economic Outlook Conference, a Carolina Business Review special presentation. For more information, visit carolinabusinessreview.org.